on emerging markets. Harold van der Linde, the head equity strategy Asia Pacific at HSBC, joins us now to give us his view. They've written a note where they say that Asian equities will struggle with no signs of a recovery in Chinese earnings growth, but still, because of low valuations, they prefer China over India. Harold, hi, good morning, and thanks for joining us. The IMF has downgraded global growth and has also said that the China situation is worse than what they had expected. How much incremental bad news would you expect from China, and how much of that do you think is already in the price?
Well, in a sense, you answered the question already with it being in the price. So we know that growth is quite weak, and we've seen that the IMF has further downgrade some of their estimates, and they're looking for, I think, it's 6.8% this year, and in China 6.3% for next year. So that's all right, but valuations have come down for the Chinese market as well. The way I look at the Chinese market is basically it's a trading market. I think fair value is somewhere around 11 times earnings. If it trades at a significant discount to that, it is a good idea to be overweight on China. That's where we are at the moment.
Okay, so you're overweight on China, but given the growth problems that we've been beset with for a larger part of this year, would you write off equities as an asset class for the rest of the year?
Well, equities as an asset class, I would not write that off as for the rest of the year. And literally, I'm highlighting it in the near term. I do think what we might see is a bit of a bounce in markets. If you look at various indicators, you could look at valuations, you could look at the call spreads in the US market, you could look at retail surveys. It does appear that some of the sentiment indicators are a little bit in oversold territory, so you might get a bounce back. Currencies have moved a lot, PEs are lower, earnings estimates have come down. But a bounce is only what it is, a temporary recovery in markets. For anything more sustainable to take place, we need to see China to turn around, or at least to stabilize, so that we have a better grip on the numbers there. And that, I suspect, will take a bit of time to materialize.
Okay. Morning, Harold. If you can elaborate a little more on China. We spoke earlier today to a Chinese expert who thinks, like the IMF, that 6.8% growth is well within the grasp of that economy. Is your sense that all the bad news is known about China and that the markets have adjusted to that 6.8, or do you think that there's going to be further bad news?
No, I actually think that markets are adjusting to levels even below that at the moment. So if you look at bottom-up indicators and across China, it does appear things are not as bad as at least what some people in the media are suggesting, right? I'll give you one example. UnionPay has come out and said that spending in luxury hotels in China in August is as high as it's ever been. So clearly, I mean, there seem to be things going on. My Chinese strategist here in Hong Kong showed me a nice chart whereby the amount of cargo that is being trained around China is down, I believe it was down 5% year on year. But the amount of passengers being trained around is up 20% year on year. So we see shifts taking place in that economy, away from investment to consumption, away from manufacturing into services. And that blurs the picture. That comes, of course, with a lower growth profile, but also sometimes blurs the picture. The things which we were used to look at to understand what was going on in China need to change as well. That uncertainty is a little bit added to that picture. But if I look at from a bottom-up perspective, I don't think that the economy is collapsing as much as it is. And anywhere GDP growth between, say, 6.5% to 7% seems to be quite achievable. We're actually looking for 7.1% this year as a house.
Okay.
Mm-hmm.
Well, that brings us directly to your view about India. Indian growth has been lowered both by the Reserve Bank and by IMF 24 hours ago by about 20 basis points, 7.3 or thereabouts. What's the take on Indian equities?
Well, there's a lot of things to like about the Indian equity, so let's start off with that. Interest rates have come down this year, although I think they'll probably keep it on hold for some time. Earnings growth is better than elsewhere across the region. In the beginning of the year, the consensus was looking for about 18, 19 or 20, even close to 20% earnings growth. Now it's about 11%. Might come down a little bit further. So there's decent growth in there, and it's relatively well exposed to lower commodity prices and less exposed to the downturn in China. So that's all positive, right? But now, on the flip side, because the earnings have come down more than the markets come down, actually price-earnings ratios have gone up in India this year, which is against all the other markets. So it's become even more expensive. And this is my biggest worry. Everybody is hiding in India. Global fund managers are overweight India. Emerging market fund managers are overweight India. Asian fund managers are overweight India. I mean, it's difficult to find somebody who's not overweight India. So this is my worry. If we do see a recovery in some of the other markets, or we see other risk factors suddenly coming back, you can only sell what you own. And that's where I think it's very much a consensus trade. And you've got to be careful with consensus trades. So that's why we're cautious, actually, on India.
What's the biggest risk for India now?
I think the biggest risk is not necessarily reform momentum. I don't think it is earnings either. I really think it's that holdings that it is a consensual overweight, that everybody's hiding there. And in that sense, the biggest risk is if, for example, we do see stabilization in China coming through, the Chinese market suddenly look at attractive, people want to switch in that market, well, they'll probably fund that out of India. Do I think India will therefore drop a hell of a lot? I don't really think so. But on a relative basis, I think China starts to look a little bit more even defensive and looks a little bit more attractive than India at the moment.
Where are you weighted on India? Even when something is screamed out, what will be the relative outperforming sectors here?
Well, I think there's a couple of sectors which we look at. We know that U.S. consumption is doing relatively okay in a very low growth world environment. So some of your companies are exposed to that. So thinking, for example, about selected IT names here. And then, of course, you've got lower interest rates coming through, which is good for some cyclical sectors. So selected auto stocks, for example, would look good there as well. If there was more going on in terms of infrastructure, that's the place to look as well. Although the valuations for some of the key stocks are a little bit too high for myself. But yeah, cyclicals in that sense, I would prefer.
Okay. You were saying that the biggest risk for India now is the fact that everyone is overweight on India. But in your interaction with the long-only funds or with foreign investors, are you getting a sense that some of that enthusiasm has waned, or are foreign investors still looking at increasing their allocations to India?
Well, I would say if that enthusiasm could have been described as being euphoric about 12 months ago, with people dancing on the tables. At the moment, we're off the tables, but it still feels like reasonably good. But I must say that over the last 10 days in my conversations with regional US and European-based funds, some of that mood seems to be changing, and as I said, I think that's driven by China to a certain extent. And that some of the other markets have started to look a little bit more interesting. So I don't think people are lining up to sell and leave that market whatsoever. But on the margin, I think you might see a bit of rotation taking place. But in general, I would say the feeling is still that people, they like structurally India because there is a bit better growth and there is a bit of reform taking place. Interest rates can come down a little bit further. So it ticks a lot of these boxes. But the mood is changing away from euphoric to just, say, more normalized levels of optimism.
Okay, let me come to crude. Lately, over the last, 48, 72 hours or maybe a week, we are seeing a floor being put to crude prices. Noises about Russia negotiating with OPEC may have added to it. But there was one forecaster actually calling for a turning point in crude. Do you see some fairly longish bit of upward correction in crude prices?
Longer term, actually, yes, we do believe that it is the case. Fundamentally, it's a market that remains oversupplied. So prices have come down to that, and rebalancing is ongoing, but it remains quite slow in that market here. But if we work through that, we see oil prices going to 60, 70, and $80 in 2016, 15, 16, and 17 by year end this year. 2015, 16, 17. So we see a gradual recovery, and that's really against a weak demand environment that you have a supply adjustment taking place, and that rebalancing is still taking place. But it is interesting to note that actually oil prices, given what is going on in the Middle East, haven't really spiked, which it normally does if there's so much unrest in the Middle East. So clearly, demand is a worry as well.
Okay, all right, Harold, we leave it at that. Thanks for joining us and giving us your view. That's the word coming in from HSBC. China looks better than India, but that's because of the valuation, discount that China is trading at.
You're way too well loved. That's our problem.
Yeah.
That's the way Heidelberg.
Yeah, the biggest risk is that everyone's overweight on India. All right, but let's talk about some sectors now. The cement space, let's find out what's happening there. Jamshad Nawal Cooper, the CEO and MD of Heidelberg Cement, joins